All right, let's dive into Gulf Oil Lubricants' latest earnings report, because it's a real head-scratcher. You've got record sales on one side, and on the other, profits are taking a nosedive. So what is really going on here?
So, let's start with the good stuff. And honestly, it's really good. The company's revenue, it shot up by more than 10% compared to last year. I mean, that's a huge sign of a business that's just crushing it. But don't get too comfortable, because here's where it gets weird.
And yeah, here's that twist. While sales are just booming, profits absolutely cratered. We're talking a drop of almost 22%. Now, how on earth does a company sell more stuff than ever before but end up making less money? It doesn't add up, right?
So that's the big question, isn't it? A booming business with profits that are falling off a cliff. What is the real story here? Come on, let's peel back the layers and actually figure this thing out. Okay, first up, let's tackle what I'm calling the headline puzzle. You know, this is one of those classic situations where the top line, that's your total sales, your revenue, is telling you one story, and the bottom line, your actual profit, is telling you a completely different one.
And when you put the numbers side by side like this, man, it really hits you. Just look at that revenue line. It jumped up to over 1,000 crores. That's a fantastic 10.56% increase. But then your eyes drift down to the profit line and, oof, it went from 97 crores down to just 76 crores, a 21.77% drop. Seeing it laid out like this really drives home that contradiction. So, what gives?
All right, to get to the bottom of this, we've got to pop the hood and look at how the company is actually doing, operationally. Because, and here's a little spoiler for you, despite that scary profit number, Gulf Oil's core business engine is absolutely humming. And get this. The company didn't just sell a little more. They hit their highest ever quarterly sales volume in their entire history. We're talking 41,500 kiloliters of product. This isn't just a small bump, folks. This is a record-shattering performance. So, the plot thickens, right?
And this chart, it just perfectly shows the scale of what they've pulled off. The entire lubricant industry grew by a pretty solid 4%, but Gulf Oil, they grew by 8%. That's double the pace of the whole market. What that really means is they are just gobbling up market share. They're not just growing with the tide, they are actively stealing business from their competitors. This is not a company that's in trouble. This is a company on the attack.
And this crazy growth wasn't just some one-hit wonder in a single area. No way. It was happening everywhere. We're talking high double-digit growth in car oils for you and me, all-time record volumes in motorcycle oils for workshops, and yeah, double-digit growth in their huge industrial and mining contracts too. The whole business is just firing on all cylinders.
All right, so we've settled that part of it, right? The core business is absolutely booming. So now it's time for the big reveal. Let's solve this profit mystery once and for all by pinpointing the exact one-off items that are messing with the numbers and hiding what's really going on. And you know what? It really just boils down to two things. That's it. First, there's a one-time charge because of a new labor code. And second, last year's profit was artificially high because they sold a piece of land. Let's break them down. Okay, so culprit number one is this thing called the labor code provision. The company basically had to put aside almost 23 crores to follow some new rules. Now here's the absolute key thing to understand. This is a one-time accounting thing. It has zero to do with how much oil they sold this quarter or how well they ran their business. It's just a regulatory thing they had to do. And the second piece of this puzzle is actually about what happened last year. See, in the same quarter last year, Gulf Oil made an extra 12 crores just by selling some land. Now, that was awesome for them at the time, but it pumped up that year's profit number, making this year look kind of weak in comparison. It's what we call a high base effect, when a really good result in the past makes a normal, good result now look bad. And boom, here it is. This is the aha moment. On the left, you see that scary number we started with, profit down almost 22%. But just watch what happens when we clear out all that noise, when we adjust for those two one-off things we just talked about, that labor rule and the land sale from last year. The entire story just flips on its head. The company's real underlying profit didn't shrink at all. It actually grew by a super healthy 7.4%. And just like that, the paradox is solved. Okay, so now that we've sorted that out, let's talk about the future. Because honestly, the real story here isn't just about oil and lubricants anymore. It's about a huge, strategic pivot into e-mobility.
Yeah, Gulf Oil is not a company that's just sitting around watching the world go electric. Nope. They are jumping into the electric vehicle space with both feet, and it's a way bigger part of their game plan than you might think.
I mean, just look at this number. Tyrex, that's their EV charging company, saw its revenue grow by a staggering 83% in a single quarter. That isn't just growth, my friends. That is explosive off-the-charts growth.
And this isn't just some pipe dream. Tyrex is already turning into a powerhouse. It actually hit positive EBITDA. That's a key way to measure core profit, which is a massive milestone for a new business. In fact, Gulf Oil's board is so hyped about it that they just approved upping their ownership stake to over 65%. That's them putting their money where their mouth is. It's a huge vote of confidence in the future of EV charging.
But, and this is super important, they are not abandoning their main business, not even close. At the same time, they're pouring money into expanding their lubricant production by a whopping 70%. This tells you they're planning to dominate in both their traditional market and the market of the future. They're playing both sides, and they're playing to win.
So, let's bring it all home. It's time for the final verdict. Beyond those misleading headline numbers, what does all of this really mean for the big picture at Gulf Oil?
You know, this quote from the analysis just nails it perfectly. The slump in net profit is largely accounting-driven and regulatory in nature. Operationally, Gulf Oil is at its strongest point yet. I mean, that's it. That's the whole story in a nutshell.
And look, if you need one last undeniable piece of proof that the company is confident, here it is. The board just declared an absolutely massive interim dividend of 21 rupees per share. You just don't do that. You don't hand out that kind of cash if you are even a tiny bit worried about the health of your business.
And that's the bottom line, isn't it? Actions speak way louder than a couple of weird accounting entries. That profit dip, it was just noise. A huge dividend like this, that's management screaming from the rooftops that they believe in strong, steady cash flows for years to come.
And all of this leaves us with one last, really fascinating question to chew on. When a company's past is built on oil, but its future is clearly electric, how do you even begin to figure out what it's truly worth today? That's the real challenge, and the huge opportunity for anyone looking at Gulf Oil right now. Thanks so much for tuning in.
Welcome back to the Deep Dive. We're doing something a little unusual today.
Yeah, definitely unusual for us.
Because usually, we're just drowning in a sea of PDFs and long articles and 50-page earnings reports to make sense of a topic. But today,
Today we have exactly one source.
just one, which is wild, but it is a very dense one.
Oh, absolutely. It's
Dense?
packed with information if you know how to read it.
So for you listening right now, imagine we are staring at a single image. It's a technical stock chart for Gulf Oil Lubricants India Ltd.
And the ticker symbol on that is GLFOIE LUB. That's on the National Stock Exchange.
The NSE, right. And the timestamp on this thing is, well, it's totally fresh. It's frozen right at the close of markets today, February 20, 2026.
So it's a snapshot of a very specific moment in time. But it's also a history book.
See, that's exactly what I love about this.
Yeah.
Because for anyone listening who hears the phrase technical analysis and immediately wants to skip ahead, don't.
Yeah, stick with us.
Because looking at this chart, I realized it's not actually about math. I mean, sure, there are numbers all over it, but this looks way more like a map of human psychology.
That is the absolute best way to frame it.
Right. It's a map of fear, greed, and right now, a whole lot of confusion.
Exactly. A chart is really just a visual record of millions of decisions made by thousands of people who have real money on the line.
High stakes.
Very high stakes. It tells you exactly where the crowd panicked, where they got a little too overconfident, and where they basically just gave up. And if you look at the last 3 months for Gulf Oil Lubricants from November 2025 to right now, the crowd has been through the ringer.
Oh, it has been a total drama. So let's set the stage for you. We need to turn this audio into a visual. Imagine a dark, sleek trading terminal screen.
Standard dark mode layout.
Yeah. And this one has a faint watermark in the background that says Nuvama, which is the platform we're viewing this on.
Right. It's a standard daily candlestick chart, meaning each little vertical marker represents one day of trading.
But it's layered. It's almost like a cake.
Mm.
We have the main price action taking up the top 2/3 of the image. Then underneath that, we have this little purple line oscillating inside a box,
That's the RSI.
the RSI.
Right.
And then at the very bottom, we have these vertical bars, which is the volume.
Correct. So you have 3 distinct layers of information. The price at the top is the what. The volume at the bottom is the fuel. And that RSI in the middle is the speedometer.
Okay, I like that. The what, the fuel, and the speedometer. I want to start with the what, the price action right at the top. Because looking at this timeline from left to right, it really looks like a landscape.
A very bumpy landscape.
Yeah.
Yeah.
We start on the far left in November of last year, and it seems, honestly, it seems kind of boring.
Well, it was deceptive. If you look at November and December 2025 on that left side, the stock was trading relatively high. It was up in the 1150 to 1200 rupee range.
Right.
But look closely at the candles themselves.
They're messy. Like it's a red day, then a green day, then another red day. It's just chopping sideways.
Exactly. Traders call that the chop. But notice the slope of that chop. It wasn't a perfectly flat line. It was slowly, quietly bleeding out.
Just drifting down.
Drifting down. It's kind of like a ball rolling gently toward the edge of a table. Investors were comfortable, maybe a little complacent even. They thought that 1150 level was a safe, solid floor.
And then January 2026 hits.
Yeah.
And the bowl doesn't just roll off the table. It looks like someone kicked it off a cliff.
That is the crash. You can see it visually right in the dead center of the image. The candles turn bright red, and they get significantly longer.
It's like a waterfall, just red bar after red bar after red bar.
And that represents heavy, sustained selling pressure. The sentiment in the market shifted instantly from, hey, let's hold this, to get me out right now at absolutely any price.
Panic.
Total panic. This stock plummeted from that comfortable 1150 level all the way down to, well, look at the low point there in late January.
Oh, I see. It looks like it bottomed out right around 1,000, maybe 1020.
Roughly 1,000 to 1020, yes. That is a drop of nearly 15% in a very short window.
Wow.
And psychologically, you have to remember, that is terrifying for a regular retail investor. Imagine you open your brokerage account every single morning and you just have less money than you did the day before.
Yeah, that creates a visceral reaction.
It forces people to make emotional decisions.
And that visual valley in the middle of the chart is so deep, but then almost as fast as it fell, it bounced. February looks like a totally different story.
This is your classic V-shaped recovery. Suddenly, the sellers just ran out of ammo, the candles turned green again, and not just weak, little green blips. These are strong, tall green candles marching right back up the hill.
It climbed almost all the way back to where it started. It looks like it hit maybe 1180 or even 1200 again by mid-February.
It did. The market has a notoriously short memory. The fear evaporated, greed took over again, and everyone who bought the dip was rewarded.
But, and I guess here's the twist in the movie, it didn't hold. Because now we're looking at the far right of the chart, the last week or so leading up to today, February 20th, and it looks like it just slammed into an invisible ceiling.
Well, it's not invisible if you know what you're looking for. Do you see those faint green lines flowing around the price candles up top?
The ones that kind of look like a riverbank?
Yes. The price is sandwiched right between them. Those are called Bollinger Bands.
Okay, unpack that for me,
Yeah.
because usually when I hear Bollinger Bands on financial news, I just nod and pretend I know what it means. What are they actually telling us here?
Fair enough. So, without getting bogged down in the complex math, Bollinger Bands measure volatility.
Okay.
The middle line is usually a 20-day moving average of the price. The top and bottom green lines represent 2 standard deviations away from that average.
Standard deviations. So we're talking about statistics and probability.
Exactly. Statistics tell us that roughly 95% of the price action should happen inside those bands. Think of the outer bands like an electric fence.
An electric fence. I like that.
Right, because when the price touches the outer band, it's considered a statistically extreme move. It's gone too far too fast.
Okay, so when the price rallied so hard in mid-February and slammed into that top green line,
It was stretching the rubber band way too far. The statistics essentially said, okay, calm down, we've moved too quickly. That upper band acted as a hard ceiling, a resistance level. The price hit it, couldn't break through, and got rejected.
and that rejection is what caused this slide back down over the last few days.
Precisely. The market is just reverting to the mean. It's catching its breath after sprinting uphill for 2 weeks.
Okay, so that perfectly explains the movement. But I want to know about the conviction behind that movement. Because, I could paint a chart to look like anything, but if nobody's actually in there trading the stock, the price movement doesn't really matter, right?
That is the golden rule of technical analysis. Price is the advertisement, but volume is the sales figures. You always have to check the sales figures.
So let's look at the fuel tank, that bottom section with the vertical bars. Some are really short, some are really tall. What catches your eye down there?
There are two distinct days that tell the entire story of this crash and recovery. And they are absolutely textbook examples of how smart money, the big institutional investors, operate versus dumb money.
Okay, show me the dumb money first.
Look right at the bottom of the crash. Around January 16th, do you see that massive red bar sticking up way higher than anything else around it?
Oh, yeah, it's a skyscraper compared to the rest of the neighborhood.
That is what traders call capitulation.
Capitulation, literally giving up.
Exactly, throwing in the towel. That massive volume spike represents the moment of maximum panic. That is likely the retail investors, just regular folks, who held on all the way down the cliff from 1150, hoping every day it would turn around.
And it didn't.
It didn't. So finally, at the very bottom, they just couldn't take the financial pain anymore. They puked the stock. They sold everything at a huge loss just to stop the bleeding.
That is so tragic. They sold right at the absolute bottom.
Almost always. It's a psychological breaking point. That massive volume spike usually marks the bottom of a crash because once everyone who wants to panic has finally sold.
There's nobody left to sell.
Exactly. There are no sellers left. And that is exactly when the smart money steps in.
So where did the smart money show their hand here?
Fast forward to the recovery rally. Look at around February 11th. We're about halfway up the hill.
Okay, I see a pretty significant green volume bar there. It's not as high as the panic bar, but it's definitely a strong spike compared to the days around it.
That is the conviction point. That green volume tells us the rally wasn't just a fluke. It wasn't a dead cat bounce, at least not initially. That volume means big money, institutions were actively buying. They waited for the dust to settle, saw the stock was cheap, and started accumulating heavy shares to push it up.
Fascinating. So we had pure panic selling in January and strong institutional buying in early February. But what about right now? Because I'm looking at the volume bars on the far right, the last few days leading up to today, Feb 20th, and they were basically non-existent.
They are tiny. They've almost entirely disappeared.
What does that mean? Is everyone just on vacation?
It means the market is in a total stalemate. We had the violent crash, then we had the violent recovery, and now nobody really knows what to do next. The volume drying up like this interprets as a collective wait-and-see approach. The buyers are sitting there thinking, I'm not buying here at 1080. It feels too expensive after the huge rally. And the sellers are thinking, well, I'm not selling here. I don't want to miss out if it runs back up to 1200.
So it's a standoff, like two gunfighters just staring at each other, waiting for the other one to blink.
That's exactly it. And honestly, low volume during a pullback, which is the slight dip we're seeing right now, is actually somewhat healthy. It just means people aren't rushing for the exits again in a panic. Yet.
That is the key word. So let's look at our third layer of evidence to see if we can break the tie. The speedometer.
The RSI.
Right. The RSI in that middle box is just a purple line squiggling around.
Right.
How does this help us figure out who's going to blink first?
So the Relative Strength Index, or RSI, essentially measures the speed of the train, the momentum. The scale goes from 0 to 100. The standard rules of thumb are anything above 70 is considered overbought, meaning it's too expensive and might drop, and anything below 30 is oversold, meaning it's too cheap and might bounce.
Okay, let's track the timeline again using that rule. When the price fell off the cliff back in January, where was the RSI?
Look at the valley. That purple line dipped way down. It broke hard below that 30 line.
So that was the dashboard light flashing red, engine overheated, or I guess engine frozen.
More like flashing opportunity. It was telling technical traders that the selling pressure had been way too aggressive. It was mathematically unsustainable to keep dropping that fast. And sure enough, the price bounced shortly after.
And what happened during the big rally in February?
It shot right back up. It didn't quite hit the 70 overbought line, but it got very close. It showed really strong upward momentum.
But now look at it. I'm focusing on the very tip of the purple line today, Feb 20th. It's pointing downward.
It's curling over. And if you look closely at the number on the scale for today, it's sitting right around 48.50.
48.50. That is basically 50. That is the exact mathematical middle of the gauge.
It is what I call no man's land. It is completely, totally neutral. The market is neither expensive nor cheap. The momentum is just gone. The wind has dropped completely out of the sails, and the boat is just drifting.
Which perfectly reinforces that stalemate idea from the volume bars. Everything on this chart is screaming indecision.
Which, ironically, is often the most dangerous time to trade because from the dead middle, a stock can violently break in either direction.
Okay, so we had the broad strokes, but I really want to get granular here at the end. We were recording this on February 20, 2026. I want to zoom in microscope style on the very last candlestick on the far right, the one representing today. Because looking at the data for today, it feels like a whole mini battle happened just in the last 6 hours.
Let's break it down. The data box is right there at the top left of the chart. Read me the stats for today's session.
Okay, here we go. Open was 1090.00. High was 1100.50. Low was 4075.000. And the close was 2077.90.
Those four numbers tell a very specific, very dramatic narrative. Let's reconstruct the day.
Okay, so the opening bell rings this morning. We open at 1090.
Right. And at some point during the day, the bulls, the optimists, tried to make a run for it. They pushed the price up hard. They really wanted to reclaim that 1100 level.
1100 seems like a big psychological number for traders.
Huge. Round numbers almost always act as psychological barrier, so they pushed it to an intraday high of 1100.50. It just barely peeked their heads over the fence.
But they couldn't hold it.
No, they got slapped down almost immediately. As soon as it crossed 1100, a wave of sellers stepped in, probably big institutions or automated algorithms programmed to take profit at that exact level.
Yeah.
And those sellers drove the price all the way back down, past the opening price, all the way to a low of 1075.
And it ultimately closed at 1077.0. So it basically closed right on its absolute lows for the day.
Correct. If you visualize that specific daily candle, it has a small red solid body at the bottom and a long thin wick sticking out at the top.
The wick is like the scar of the failed attack.
That is a great way to put it. That upper wick represents rejection. It tells us definitively that today, on February 20th, the sellers were much stronger than the buyers. The market tried to go up, failed miserably, and retreated. That is a notoriously bearish signal for the immediate short term.
So let's try to pull all of these separate clues together into a final verdict. We have Gulf Oil Lubricants. It survived a brutal 15% crash in January. It staged a heroic V-shaped recovery in February. But now it's hit the Bollinger Band ceiling. The trading volume is completely dried up. The RSI speedometer is dead neutral at 4850. And today's candle was a harsh rejection at 1100.
That is the perfect synthesis. We are clearly in a consolidation phase, but it is tilting heavily toward weakness.
It feels like the calm before the storm. But which way does the storm blow?
That is the million-dollar question. And this actually brings us to the most provocative part of the whole chart, the one overarching pattern we haven't even named yet.
Oh, what's that?
Look at the peaks. The major highs over the last 3 months. The peak back in November was up around 1200. The peak we just hit on the February recovery rally was around 1180. And the peak we failed at today was exactly 1100.
They're getting lower. It looks like steps going down into a basement.
Exactly. Traders call that lower highs. In technical analysis, a macro downtrend is defined by a series of lower highs and lower lows. So even though we had that really nice rally in February, we have not actually broken the larger downtrend structure.
So despite how great that V-shaped recovery looked, the bigger picture is still just pointing straight down.
It's a major, major risk. And this leads to the theory that should keep every investor holding this stock up at night. Was the February rally real, or was it just a dead cat bounce?
I love that term, even though it's incredibly grim. A dead cat bounce.
Wall Street has a dark sense of humor. It's the idea that even a dead cat will bounce if you drop it from high enough. Meaning, after a massive violent crash like we saw in January, a short-term rally is completely natural. It's just mechanical. But if that rally fails to make a new high...
If it stops at a lower high.
Right. If it rolls over like we are seeing today, it's often a trap.
The trap.
Yes, it sucks in all the hopeful buyers who think the worst is finally over. They buy in at 1100 or 1150 thinking they're getting a deal, and then the price just rolls over and heads right back down to test the previous lows.
To test that 1,000 level again.
Or lower, because if 1,000 breaks, then the floor is totally gone.
That is a terrifying thought for anyone holding this right now. So the optimistic view is, hey, we are just pausing for breath on low volume before breaking 1,200. And the pessimistic view is, the cat has officially bounced, gravity is taking over again, and we are heading straight to the basement.
Exactly. And the chart gives us all the clues, but it doesn't give us the final answer key. The clue right now is that RSI curving down and that harsh rejection at 1100. The burden of proof is currently entirely on the bulls. They need to show up tomorrow with massive volume and break through that 1100 wall. Until they do, the path of least resistance is just drifting lower.
It is amazing how much narrative is hidden in those little colored bars. We started this deep dive with just a single stock chart, and we ended up with a psychological thriller about trapped buyers and institutional warfare.
It really is the heartbeat of the market. And right now, frankly, that heartbeat is skipping a beat.
Well, for everyone holding GL Oppo iLub, we will certainly be watching tomorrow's opening candle very, very closely. Will we break the ceiling or slide back down the wall? That is the cliffhanger you have to live with tonight.
That's the game.
Thanks for helping us decode the matrix today. This was way more interesting than just reading a spreadsheet.
My pleasure. Just remember the golden rule. Price pays, but volume tells the story.
Price pays, volume tells the story. I'm putting that on a t-shirt. Thanks for listening to The Deep Dive, everyone. We will catch you next time.